Welcome back to the Deep Dive. Today, we are strapping in for a really critical topic. It's navigating the complex world of international tax, wealth protection, and, well, the whole rise of the globally mobile worker.
Yeah, we're talking expats, digital nomads, high net worth individuals. It's a big landscape.
It really is.
And the material we've looked at, from groups like Nessman, Holborn Assets, plus official sources like the IRS, it all points to something important.
Which is?
That there are significant opportunities for legal tax efficiency if you're globally mobile. And it's but it absolutely requires careful, detailed, advanced planning. You can't just wing it.
No, definitely not. The rules are incredibly layered. Sometimes they even seem to contradict each other. And a small mistake like miscounting your days somewhere, it could lead to, well, financial headaches or just piles of unexpected paperwork.
Exactly. So our mission today, for you listening, is to give you the essential framework. We want you to understand how and where income gets taxed globally.
Right, giving you the core concepts so you can avoid those missteps and, maybe maximize the legitimate benefits if you decide to take your life or business across borders.
Precisely.
Okay, let's unpack this, starting with the absolute foundation. How countries even decide they get to tax you in the first place. This big divide in how they approach it.
Right. You've basically got two primary systems. There's the worldwide approach, and then there's the territorial approach.
Okay, worldwide approach, what does that mean in practice?
It's pretty much what it sounds like. If a country uses this system, it taxes its residents on income from any source anywhere in the world.
So even if I live there, but I earn money from, say, an investment property back home.
Yep, they expect you to declare that income, doesn't matter where it came from.
And the territorial approach is, I guess, the opposite?
Kind of, yeah. It offers a bit more separation. That system only taxes income earned within that country's borders.
Okay,
Yeah.
so if I'm a resident there, but I have those dividends coming from another country.
Often, yeah, that specific foreign source income might be exempt under a territorial system. It depends on the specifics, but that's the general idea.
What's really interesting, though, looking at the sources, is just how dominant the worldwide approach is. It's not like a 50-50 split at all.
Not even close. We're seeing about 104 countries using the worldwide system compared to only around 30 using territorial.
Yeah.
And that gap gets even wider in places like Europe. I think it was something like 45 out of 47 European countries use worldwide taxation for individuals.
So chances are, if you're thinking about moving, your home country probably uses that worldwide system.
Very likely, yes. They'll want to know about your global income.
Which brings us straight to the next big question. How does a country actually claim you as a resident for tax purposes? If I'm, say, a digital nomad bouncing around, when do I cross that line?
Right, that line is tax residency, and it's fundamental. The simplest, most common trigger is basically counting days. You hear about the 183-day rule all the time.
Half the year, essentially.
Yeah, sometimes it's 180 days, sometimes 6 months, depends on the country. But it's usually calculated within a calendar year or maybe a rolling 12-month period.
So if I spend 184 days in Spain, boom, I'm a Spanish tax resident. Seems a bit too simple.
And you're right to be skeptical. That's a common trap. While the day count is often the first trigger, you absolutely have to watch out for what they call connecting factors.
Connecting factors, like what?
Well, countries look beyond just where you sleep. They assess your center of vital interests. Where's your permanent home, even if you rent it out? Where's your family, your spouse, your kids?
Okay.
Where are your main economic ties? Your job, your business interests, bank accounts. These things can establish tax residency even if you were super careful and stayed only, say, 180 days. It's about demonstrating your actual ties and intentions.
And speaking of intent and where you're from, we have to talk about the U.S. situation. It's famously unique.
Yes. The U.S. operates on citizenship-based taxation. This is a really big deal. It means U.S. citizens and also green card holders are taxed on their worldwide income no matter where they live on the planet.
Regardless of residency elsewhere.
Exactly. That obligation sticks with you unless you formally renounce your citizenship, which is a whole other process, or unless you qualify for some very specific exclusions.
That system causes a lot of headaches for Americans abroad. So how do they actually manage that burden? Is there a main tool? And what's maybe the biggest non-tax hassle?
The main tool is definitely the Foreign Earned Income Exclusion, the FEIE. It's really valuable. It lets qualifying U.S. citizens living abroad exclude a pretty significant chunk of their foreign earned income from U.S. federal tax. For 2023, that was up to $120,000.
Okay, $120K is substantial.
It is the non-financial hassle. It's the sheer compliance burden, the constant reporting, even if you owe no tax. We can touch on that more later.
Right. So to get that $120,000 exclusion, what do you have to do? What are the tests?
You need to meet one of two tests. The first is the physical presence test. That's purely about counting days. You need to be physically present in a foreign country or countries for at least 330 full days during any 12-month period.
It's got to be outside the U.S. for almost the whole year.
Basically, yes. The second test is the bona fide residence test. This one's a bit more subjective. It means proving you're a genuine resident of a foreign country for an uninterrupted period that includes a full tax year. It's less about counting days and more about demonstrating your long-term ties abroad.
Okay, now let's imagine a situation. Maybe you're a U.S. citizen living in France. The U.S. claims you because you're a citizen. France claims you because you live there more than 183 days. How do you avoid paying full tax in both places on the same income?
Yeah, that's the classic double taxation problem. The solution here is usually a double tax agreement, or DTA, sometimes called tax treaties.
Okay.
These are agreements between two countries designed specifically to prevent double taxation on the same income, whether it's salary, business profits, investment income, whatever.
So how do they decide which country actually gets to tax that income?
Well, the DTAs usually contain rules, often called a tiebreaker test. It's like a checklist. They look at factors in a specific order, like where's your permanent home, where's your center of vital interests, maybe your citizenship. They go down the list until one country is assigned the primary right to tax that specific income.
So it brings some certainty.
Exactly. It provides clarity and prevents you from being taxed fully twice. It's worth noting, by the way, the UK actually has the biggest network of these treaties globally, something like 120 of them.
That's extensive.
Okay.
That framework helps a lot for income. Let's shift gears a bit now. Let's talk about protecting the wealth you've already built, using structures. The term offshore structure, like an LLC or a trust set up abroad, it often sounds a bit shady in the media, right?
It definitely gets a bad rap sometimes, yeah.
So let's unpack the legitimate reasons why people, especially high net worth individuals or businesses, use these offshore structures.
Absolutely. It's often misunderstood. These are essential, perfectly legal tools for managing wealth and assets internationally. Our sources highlight four really common, legitimate uses.
Okay, let's hear them. What's the first one?
First up is buying international real estate. In many countries, there are restrictions or just complexities if a foreign individual tries to buy property directly.
Ah, okay.
So setting up a local or offshore company to hold that property can be the simplest or sometimes the only legal way to actually own it, or it might simplify inheritance down the line.
Makes sense. What's number two?
Number two is avoiding probate. Probate is the legal process of validating a will and distributing assets after someone dies. In many places, especially common law countries, if assets are held in your individual name, probate can be incredibly slow, really expensive, and very public.
Right. I've heard horror stories.
Yeah. Holding those assets within an international trust or a company structure can often allow them to pass to beneficiaries much faster, cheaper, and more privately, completely bypassing the main probate process.
Okay, practical reasons so far. What's the third?
Third is straightforward international tax planning, particularly for businesses. Companies, especially public ones, have a duty to their shareholders to operate efficiently, and that includes managing their tax legally.
Right.
Many high-tax countries actually build incentives into their own tax codes for their domestic companies to structure international operations in certain tax-efficient ways. Using offshore entities is often simply how companies legally take advantage of the rules their own governments have created.
So it's using the system as intended, in a way.
In many cases, yes. And the fourth reason is asset protection planning. This one feels quite defensive.
Defensive how?
It's about protecting your savings and assets from potential future lawsuits or creditors. This is a big driver, especially for people in high litigation environments like the U.S.
You mean shielding assets legally?
Exactly. There was a study mentioned, I think from 2007, that estimated the cost of the U.S. lawsuit system was like a $900 billion lawsuit tax on the economy annually.
Wow, that's a staggering number.
It is. So for people in high-risk professions, doctors, entrepreneurs, successful business owners, or just anyone with significant assets, using offshore structures like LLCs or trusts can be a prudent legal strategy to protect what they've built from potential future claims.
Okay, that really reframes it from just hiding money to actual risk management. Now, let's talk about maybe the ultimate goal for some, eliminating capital gains tax or CGT, especially when selling a big asset like a business.
Ah, yes, the CGT exit. This is definitely a high-stakes area, often for H&WIs facing a big liquidity event. But there's one rule that's absolutely critical, non-negotiable, really.
Which is?
Advanced planning is everything. You must establish your new tax residency before the sale happens. If you move after you've already signed the deal or the gain has crystallized, it's almost always too late. Anti-avoidance rules in your old country will kick in, and you'll likely owe the CGT there anyway.
So the strategy is to become a genuine tax resident in a country with zero CGT before you sell. What kind of countries are we talking about?
We're talking about places that simply don't tax capital gains on investments. Think Monaco, the Cayman Islands, Singapore's quite popular, Belize, even New Zealand for certain types of assets. You move there, establish real residency, then sell your shares or your business, and the profit is potentially tax-free.
What about real estate, though? You can't exactly pick up your office building and move it to Monaco.
True. For real estate, the PAX is almost always tied to where the property is, so moving won't help escape CGT on the property itself if the country where it's located taxes it. But some countries also have zero CGT on local property sales. The sources mentioned Monaco again, and also the UAE, like Dubai. So strategic property investment there could avoid CGT on sale.
Interesting. And there was a specific mention, a kind of loophole, for Americans who want zero CGT but don't want to give up their passport.
Yes, the Puerto Rico situation, using their Act 60 incentives, this is quite unique. For U.S. citizens, especially maybe active traders and things like crypto, if they become bona fide residents of Puerto Rico.
Which is U.S. territory.
Exactly. If they qualify under Act 60, they can potentially get a 0% capital gains tax rate on investments they make after moving there, and they remain U.S. citizens. But again, the key is establishing that genuine residency before the gains happen.
Fascinating. Okay, that leads perfectly into some actionable takeaways for our listeners. But first, let's really hammer home that crucial difference you mentioned earlier. Tax avoidance versus tax evasion.
Absolutely critical distinction. You have to know where the line is. Tax avoidance is using the law as it's written to minimize your tax bill. It's perfectly legal.
Like claiming deductions you're entitled to. Mortgage interest, retirement contributions.
Precisely. Or structuring your affairs in a tax-efficient way, like choosing to live in a low-tax jurisdiction, or using those offshore structures we discussed for legitimate purposes. You're using the legal framework available.
Okay, so avoidance is playing by the rules, just playing skillfully. What's evasion then?
Tax evasion is illegal. It's deliberately not paying taxes you legally owe, or willfully underpaying them. This often involves fraud, like hiding income, maybe dealing in the underground economy, falsifying records. That's breaking the law.
Got it. Clear difference. Now, let's talk about risk, but from the employer's perspective. If I'm working remotely from another country as a digital nomad, what's the biggest, maybe hidden risk I could be creating for my company back home?
This is a huge one and often overlooked. It's the risk of creating a permanent establishment, or PE, for your employer in the country where you are living and working.
Permanent establishment. What does that mean practically?
It means you, the employee, might unintentionally create a taxable presence for your company in that foreign country.
How? Just by working from my apartment?
It can happen a couple of ways. If you work from a fixed place of business, and yes, a permanent home office can sometimes count, that can be one trigger, or critically, if you act as what's called a dependent agent. Meaning you have the authority to, and routinely do, conclude contracts on behalf of your employer while you're in that foreign country.
Wow. Okay, so if I'm signing sales deals from my kitchen table in Portugal,
you could potentially be creating a PE. And if a PE is triggered, suddenly your employer might have a corporate tax liability in Portugal. They might need to file Portuguese corporate tax returns, pay Portuguese taxes on profits attributed to your activity there, and deal with potential double taxation headaches. It's a massive compliance issue for the company.
That sounds like a nightmare most companies aren't prepared for.
Many aren't, no. It requires careful management of remote work policies.
Okay, last area. Beyond the big picture tax stuff, what are some common, maybe costly oversights people make when they move or work globally? The details they forget.
Two things jump out immediately, and the penalties can be surprisingly harsh. First is immigration and the right to work.
You mean having the right visa?
Exactly. Just having a tourist visa or even a standard business visa often isn't enough for actual day-to-day work. Those might only cover short trips for meetings or training, what they call ancillary activities. If you're actually performing your job duties long-term, you need the proper work permit or visa for that country.
And if you don't?
You could face deportation, and your employer could face significant fines and sanctions. It's fundamental. You need the legal right to work where you are working.
Okay, crucial. And the second oversight, you hinted at this earlier with the U.S. system.
Yes, reporting requirements.
Eh.
Especially, though not exclusively, for U.S. citizens. They have a duty to report their worldwide income, yes, but also their foreign financial accounts. This involves filing forms like the FBAR report of foreign bank and financial accounts if your foreign account balances exceed certain thresholds.
Right, the FBAR. And FATCA, too.
And FTCA, the Foreign Account Tax Compliance Act, which involves reporting certain foreign financial assets on your tax return itself, Form 8938 usually. These are informational returns, meaning they don't necessarily mean you owe tax, but the penalties for failing to file them,
They're severe.
they can be draconian. Seriously. Penalties for failing to file an FBAR, for example, can be enormous, sometimes even exceeding the balance in the account you failed to report. It can be civil penalties, potentially even criminal in willful cases. Many expats and nomads get caught out by this, especially if they have relatively small accounts they didn't think mattered. The U.S. government takes reporting very seriously.
Wow. Okay, so the takeaway isn't just about the tax itself, but the paperwork and reporting are absolutely critical.
Absolutely. Compliance is key.
This has been incredibly enlightening. I think the core message really has to be global mobility, working or living abroad. It's definitely achievable, and it can be highly tax efficient.
But you absolutely must shift from just thinking about it, from intention to detailed advanced planning. Way before you make any major move, sell a big asset, or change your life circumstances.
Yeah, get advice early.
Definitely. Understand your specific tax residency status. Don't just rely on the 183-day rule. Seek qualified advice tailored to your situation well in advance. And remember, the world is moving towards more transparency. Things like FATCA, the Common Reporting Standard, the expansion of tax treaties. It means governments are sharing more information. Proper compliance isn't just good practice anymore, it's becoming essential.
Okay, let's leave our listeners with a final thought then. We've talked a lot about tax structuring, often framed around just, keeping wealth. Maybe flip that perspective. Think about the freedom it could enable. What personal goal, what business ambition, what kind of life freedom could you achieve if you took steps today to legally optimize your financial structure, years before you actually need it for that big business sale or that move abroad? The planning, the opportunity, it really starts now.